Good morning, and thank you all for joining us today. My name is Rich Flanagan. I'm a tax partner here at the firm. My role here is to oversee all tax functions for the firm, including tax compliance, planning, and research. I'm also responsible for client communication for most of the tax-related issues that hit your email boxes. We are quite busy with client communications, especially earlier in the year when tax changes were coming to us fast and furious. It was quite a task to even keep up with the states as they changed their 2019 tax filing deadlines in response to the COVID-19 pandemic. From a CPA's perspective, the timing of the COVID-19 shutdown could not have come at a worse time, the middle of March. Instead of working on tax returns, we were busy trying to get information to our clients that would help them and their businesses during a very difficult time. Today, I'm going to be speaking to you about the Paycheck Protection Program, otherwise known as PPP, and bring you up to date as to where we are today with the program. I'm also going to take a brief look at President-elect Biden's tax proposals and potential future effect on tax policy, and also touch on the status of any new stimulus or legislation. This webinar has been recorded, but you are able to submit your questions during the presentation as time allows. If we are not able to address your particular question due to the constraints of the format, please do not hesitate to reach out to your Maillie representative for follow-up. With that out of the way, let's get started. Back to the beginning. The Paycheck Protection Program, better known as PPP. For us, PPP is one of the most famous acronyms that has come out of the COVID-19 pandemic. With the CARES Act, PPP became part of our language and caused us and our client businesses many long days and nights trying to decipher the applicable sections of the CARES Act pertaining to the PPP. Overnight, figuring out how to help our struggling clients and to help determine how this new program could help their businesses became our focus instead of finalizing tax returns. PPP was established by the CARES Act on March 27th of 2020. Looking back 8 months ago, did anyone think that we would still be where we are today in terms of dealing with the effects of this pandemic? Little did we know back then that we would only be in the very early stages of the challenges that we continue to face today. The CARES Act itself is a massive piece of legislation, some 800 pages long, and spends over $2 trillion. That amounts to about $6,000 per American and is about 45% of the total federal spending for all of 2019. Think about that. Collectively, the government, you and me, we spent or promised to spend 45% of all of the 2019 expenditures in the space of a couple weeks. The CARES Act went from introduction to signed legislation in about 9 days. So it was inevitable that there would be some confusion, drafting errors in the legislation, and lack of practical considerations. We saw much confusion, especially in the initial stages of the CARES Act and PP rollouts, and I'm sure you all did as well. Although Congress was trying to do the right thing, SBA and the Treasury Department certainly did not do any favors for those of us placed squarely in the middle of everything, CPAs and bankers. From the outset, we knew that this was going to be a difficult challenge for us, and we were going to be in for a long, interesting ride. The banks had difficulty getting information from SBA, and there were quite a few areas of the PPP section of the CARES Act that needed clarification and reclarification after that several times to get even to the point where we had an application form that we could use. The sheer scope of the program overwhelmed SBA and stretched its resources to the breaking point. I read somewhere that for 2019, SBA approved more than 58,000 loans and provided more than $28 billion to small businesses. Contrast that with the unprecedented demand for PPP loans that we saw back in the spring. PPP by the numbers. As you can see, the PPP total lending totaled over $525 billion through the course of the program. The original amount of PPP loan funding by the CARES Act was about $349 billion. If you recall back to April 2020, there was a mad scramble to apply for the funds, and as predicted by many folks, the well quickly ran dry. Due to the overwhelming demand for this financial assistance, Congress added a second batch of funding to the tune of $310 billion for a total PPP appropriation of $659 billion. Strangely enough, whether it was because of circumstances or publicity troubles with some recognizable companies taking PPP money, we'll talk about that later, when the PPP program ended in August 2020, there were still about $134 billion unclaimed. It really was quite remarkable that times were so dire and uncertain that businesses were applying for loans, the terms of which weren't even finalized. Application forms were constantly being revised, and SBA was continuing to release almost daily updated guidance. As I previously mentioned, many of us here at the firm spent hours trying to keep up with the moving target that was the PPP. Those involved in the administration and development of the PPP and its processes likened it to flying a plane before it was built. Since no program like this had ever been available, we were all learning on the fly. You can see more than 99% of the PPP loans made were for less than $2 million, and that covers about $492 billion of the total PPP money lent. Less than 1% of the PPP loans were for more than $2 million, which covers about 33 billion of the total PPP money lent. The average PPP loan was for about $101,000. So small businesses were served by the PPP. Whether it was enough or too much depends on your definition of small business. While it was a worthwhile program, even with its shortcomings, to be honest, it would be difficult for any government program of this magnitude thrown together very quickly to address a potential economic catastrophe to not have situations where it didn't hit the mark. As a taxpayer, I hope the powers that be learn from their mistakes and use that information in the future. Next, we'll take a look at recent developments with the PPP program. First thing I wanted to look at was change of ownership issues for companies with outstanding PPP loans. Since we have been getting a steady stream of information regarding PPP loans and forgiveness over the past 8 months, the term recent developments doesn't always mean much. But within the last month or two, some good information has been provided and has answered some of our questions. One of the scenarios not really on the radar when PPP was created was change of ownership. What happens if a PPP borrower has a change of ownership after the loan is made, but before the loan is forgiven? SBA recently issued a notice to address procedures for changes of ownership. A change of ownership will be considered to have occurred in the event of a 20% change in stock or other ownership, a 50% change in sale of assets, or if the entity merges with another entity. The PPP lender must be made aware of any pending change in ownership, and copies of the agreement of sale and other documents affecting the change must also be provided as well. The original PPP borrower remains responsible for everything related to the PPP loan, the certifications, the compliance, and retaining all required documentation. In the case of a change in company ownership where PPP is involved, the important question is who must approve the prospective change in ownership, SBA or the lender? Of course, in a normal business sale situation, no one other than the buyer or seller need be concerned about this. The game changes, however, when a PPP loan is involved. Certain changes in ownership need prior approval by the SBA. If the sale is for 50% or less of the common stock or other ownership, or the PPP borrower completes a forgiveness application to the PPP lender, and an escrow account controlled by the PPP lender is established with funds equal to the outstanding balance of the PPP loan, then SBA approval is not required and the lender can approve the change of ownership. Otherwise, if circumstances don't meet the above, SBA approval may be necessary. The takeaway here is that if the situation affects you and your business, make sure the bank is aware, and you'll probably have to set up an escrow account for the remaining balance on the PPP loan with the lender. On October 8th, the SBA issued some streamlined forgiveness application, Form 3508S. This form can only be used for PPP loans of less than $50,000 and requires less information to complete. There was some talk early on about having a simpler PPP form for loans under $150,000 and possibly not even having to apply for forgiveness for loans under that amount. Unfortunately, SBA settled on a smaller loan threshold of $50,000 for the new form, and they did not do away with filing the loan forgiveness application. I personally can't see them going to automatic forgiveness without any application. That said, I really don't think SBA or the Treasury is going to bother too much with these smaller PPP loans, but I do think they still want to have the additional certifications and signatures that come with an application for forgiveness. I just don't think the optics are good if the Treasury just forgives all loans under X dollars without some kind of formal application process. Recent developments continued for the PPP program. SBA has recently issued 2 additional forms to be filed with certain PPP loans. If you recall, in the beginning of the PPP loan application approval process, you might remember that there were several large publicly traded companies that applied for and were granted PPP loans. Shake Shack, a publicly traded company, was one. The Los Angeles Lakers NBA basketball team was another. This obviously was not a good look for the SBA or the Treasury. How were these very large, valuable companies with access to capital markets able to secure PPP loans? The problem was with the original PPP loan application form. In order to be eligible for a PPP loan, the borrower had to certify that, quote, current economic uncertainty makes this loan request necessary to support the ongoing operations of the business. But what did this really mean? It was a subjective standard that didn't provide any guidance as to who was eligible for a PPP loan. Since PPP loans only required payroll and other expense information and didn't require any financial information or the inability to get loans other places, applying for the PPP became the new Wild West. Many of these larger companies that shouldn't have been considered eligible borrowers under the spirit of the program returned the money to the SBA under threat of prosecution by the Treasury. Fast forward to today. There has always been a concern about larger PPP loans, and larger PPP loans have come to be defined as those over $2 million. Treasury Secretary Mnuchin has indicated that all loans over $2 million will be audited, although this doesn't mean that the Treasury is limiting itself to audits only for larger borrowers. The thought is that the larger the PPP loan amount, the greater the possibility that PPP funds may not have been, quote unquote, necessary to support the ongoing operations of the applicant and may not be forgivable. These 2 new forms provide SBA with additional information pertaining to the financial picture of the PPP borrower. For example, question number 1 in the liquidity assessment section of Form 3509 asks, as of the last day of the calendar quarter, immediately before the borrower's PPP loan application, how much did the borrower own in cash and cash equivalents? So you can see they're looking at the financial ability of the company prior to applying for the loan. And it also asks for supporting documentation of those amounts. Although we don't know how exactly the SBA is going to use this information, it may be concerning to the larger PPP borrowers. Our own industry organization, the AICPA, has expressed concern over this new information requirement that has expressed that to the Secretary. For now, it is clear that PPP loans, $2 million or greater, are going to face additional scrutiny. The IRS has recently issued 2 rulings and procedures concerning the PPP. Revenue Ruling 2020-27 was issued, and it states that if a taxpayer has a PPP loan and has a reasonable expectation of loan forgiveness being granted, the expenses paid with PPP funds are not deductible in 2020. It doesn't matter to the IRS when the loan application is filed or the year that the forgiveness is granted. The answer remains the same. There are some that have a different interpretation or rationale for taking a contrary position on this matter, but currently this is the IRS position that 2020 is the proper year for the PPP expense disallowance. IRS Revenue Procedure 2020-51 addresses another situation that can arise with respect to PPP and loan forgiveness. It is possible that for whatever reason, not all of the PPP loan is forgiven. although the extension of the PPP spend period from 8 weeks to 24 weeks makes it more difficult, but let's assume for purposes of illustration that this happens. When a portion of a PPP loan isn't forgiven, that remainder is still considered a loan. The expenses paid with an unforgiven portion of a PPP loan should still be valid tax deductions, just like any other expenses paid for with loan proceeds. The question then becomes, to which tax year do these deductions apply? Well, Revenue Procedure 2020-51, the IRS gives the taxpayer flexibility in this area. With proper information provided with the tax return, the taxpayer can deduct those expenses on either its 2020 tax return, an amended 2020 tax return if it had already been filed by the time the forgiveness is determined, or the deductions can be taken on the 2021 return. This could be an interesting point, and the decision might hinge on the difference in expected income tax rates between 2020 and 2021. Now, again, this applies to amounts that were not forgiven through the PPP program. Paycheck Protection Program, what do we still don't know, and what do we need to still know? As of the recording of this presentation, there is nothing forthcoming or imminent on the legislative side. With the increasing number of COVID-19 cases and governmental shutdowns, one would think that additional stimulus would be toward the top of the to-do list, but again, we are dealing with Washington, D.C. Unfortunately, the election didn't answer all the questions. We are still waiting on the Georgia runoff elections, so the balance of power has not yet been entirely decided. Is it politically expedient to wait until after the holidays and after the January 5th Georgia Senate runoff election to do anything legislatively? Place your bets on where this is going. Any talk of PPP 2.0 seems to indicate that the relief will be more targeted and likely come with more restrictions. My sense is that they will use what they learned during the first go-round of PPP and clean it up a bit. PPP tax deductions. Perhaps one of the most attractive features of the PPP is that the CARES Act specifically states that any amount which would be includable in the gross income of the eligible person by reason of forgiveness shall not be excluded from gross income. Sounds pretty clear, right? Wrong. With anything taxed, there's more to the story. While this wording sounds fine, but not including the forgiven proceeds in gross income only addresses one side of the equation. The IRS, in its notice 2020-32 released back in May, considered this from the other side of it, the expense side of it. This notice basically stated that any PPP amounts spent will not be tax deductible. The IRS position is that fine, forgiveness amounts will not be included in gross income, but we aren't going to allow tax deductions for the expenses paid with PPP funds that are forgiven. It does become a matter of semantics. The letter of the law in the CARES Act states that the forgiveness won't be included in gross income, so it isn't. The IRS disallowance of the related PPP expenses as a tax deduction has the same effect of including it in income by reducing the deductible expenses. Whether the gross amount isn't included in taxable income or the expenses aren't allowed to be deducted to calculate taxable income, the effect on taxable income remains the same. After IRS released IRS Notice 2020-32, there were many members of Congress that indicated that that was not congressional intent. Many congresspersons had press conferences and vowed to pass legislation that would clarify the intent of the CARES Act and that PPP expenditures should be eligible to be tax deducted. While a bill was quickly crafted, it still currently sits in the Senate committee awaiting action. It is possible, though, that it becomes part of the next stimulus package, but timing is unclear. What is clear, though, is that the 2020 filing season will be upon us in short order, and we need a definitive answer sooner rather than later. Some of our fiscal year corporate clients ending earlier in 2020 already have this question, and we still do not have certainty in this area. When should you file forgiveness application? Slowly but surely, banks are beginning to process forgiveness applications, but some banks have not yet opened their portals for applications. Some still are saying to hold off. If you recall, in the front end of the loan application process, there were so many late changes to applications, and many clients had to apply multiple times using multiple forms. This might be part of the reason for the hesitation in pulling the trigger as well. Since there is plenty of time yet to apply for forgiveness, there doesn't seem to be any reason to rush for now. We suggest that you work closely with your bankers through the application process. My gut does tell me that it's probably not going to get simpler for the larger loans. The $50,000 threshold for using the easier Form 3508S may get raised to $150,000, but obviously we can't say for sure. That said, if you have done all the work on your application already, the application getting easier won't matter too much to you if you already qualify for 100% forgiveness. That is about all I have on PPP for now. Next up is thoughts on post-election and tax policy. While we are still a long way from knowing exactly what the Biden presidency will look like from a tax perspective, we wanted to take a look at some of his ideas. The election results weren't quite what many were expecting, and for that reason, the actual extent of the changes in tax policy remain unsettled. But hey, this is 2020, everything is unsettled. Let's take a look at some of Biden's tax proposals from the campaign trail. Based on Joe Biden's own words during the campaign, it should be no surprise to anyone that taxes will be going up. Now, to be fair, due to the trillions of dollars the country has spent during the COVID-19 pandemic, taxes are probably going up no matter who won the election. As always, the devil is in the details. While the election has given us a result for the White House, the balance of power and the scope of the election's mandate has yet to be determined. Many pundits predicted a Democratic sweep, the so-called blue wave, to happen. But a strange thing happened further down Americans' ballots. The Republicans picked up seats in the House, and the majority in the Senate will be unknown until after the first of the year, when Georgia's Senate runoff election is completed. It appears that the majority of Americans prefer divided government. While Joe Biden has won the presidency, it doesn't appear that there will be momentum for big sweeping changes in the tax landscape that a blue wave may have brought. However, that doesn't mean that the quote-unquote rich will get away unscathed. Biden seems to have settled on an income level of $400,000 in income to be considered quote-unquote rich, as many of his tax proposals increase are targeted to people that make that level of income. Candidates for president have the luxury of making general statements about tax plans and rarely have to make details available. As such, whether any of these proposals will become part of tax law or what the fine print will be if they do can only be speculation. One area of taxation that gets a fair amount of criticism and attention is Social Security. As Social Security is currently structured and funded, simple math, longevity, and yes, politicians have conspired to put Social Security system on less than stable footing. The main criticism of Social Security payroll taxes is that not all wages or income of the self-employed persons is taxed. There is a wage-based cap on the amount subject to Social Security payroll taxes, and once a person reaches the wage base, earnings are no longer subject to tax. Once you hit the limit, it's like getting a pay raise of 6.2%. For 2020, the Social Security wage base is $137,700. The theory behind the wage-based cap limiting taxation is that because Social Security benefits are limited, the income amount taxed for Social Security tax purposes should also be limited. Over the years, however, the demands for all wages to be subject to Social Security tax have grown louder. Biden's plan would subject earnings over that magic $400,000 income threshold, as well as the earnings under the wage base amount, to the 12.4% Social Security tax. This would create a donut hole for the amounts between the current wage base of $137,700 and the $400,000 that would not be taxed. The top marginal income tax rate under Biden would go back to 39.6% rate as it was prior to the Tax Cuts and Jobs Act of 2017. It will be interesting how the other brackets and income bands affected by those rates will shake out. It is one thing to increase the top marginal rate, but much of any tax increase is felt by the changes in the lower income and the rates assigned to them. Biden would increase the long-term capital gains rate from the historically low levels that we have now of 20%, back up to 39.6 ordinary income tax rate. However, this would only affect taxpayers with incomes over $1 million. The plan would also eliminate certain basis step-ups that serve to reduce capital gains. Biden's plan would also limit the tax benefits available to those that itemize their deductions for more than, again, with more than $400,000 in income. With the increase in the standard deduction and a limitation on the deductibility of state and local taxes, this has been less of an issue, but it's something to keep an eye on. Biden has also talked about expanding some of the child and dependent care tax credits, especially in 2021, as additional assistance as the country faces continuing challenges due to COVID-19. And as a help to those younger folks just starting out, Biden would bring back the first-time home buyers credit. It would provide up to $15,000 for first-time home buyers. Again, details are not available, and who would be eligible is still unknown. The estate tax area is another one where the new administration would seek additional revenue. The lifetime exemption for estate and gift tax purposes has never been higher than it is today. The lifetime exemption is the amount that any one person can give away during life or after death without incurring federal estate taxes. For 2020, this exemption is $11,580,000 for a single person, or $23,160,000 for a married couple. This means that a married couple that passed away in 2020 would not pay any federal estate taxes until their taxable assets exceeded this amount. With exemption levels this high, the federal estate tax is not something that most Americans have to worry about. The Biden plan, however, would reduce the estate tax lifetime exemption back to the amount it was back in 2009. It was $3.5 million per individual. For that same married couple under Biden's plan, their joint assets exceeding $7 million would be subject to the estate tax and would also be taxed at a higher tax rates than are currently in place. For those with significant estates, it is worth revisiting your plan to see if you can take advantage of these higher exemptions while they're still in place. The other thing I wanted to mention, but I didn't put it in the slides, is that Section 1031 exchanges for those with incomes, again, over $400,000 may also be in Biden's crosshairs. For those who are not aware, Section 1031 transactions allow the deferral of gain on the sale of real property if the proceeds are properly reinvested. Section 1031 gain deferral has always been under attack by those seeking additional tax revenues in the past, but has always remained relatively unscathed. It has been a resilient code section over the years, although the Tax Cuts and Jobs Act of 2017 did limit 1031 tax deferrals to real estate transactions only. Biden has also talked vaguely about equalizing the benefits of traditional retirement accounts by providing tax credits for retirement contributions instead of those contributions being tax deductible. The issue with tax deductibility is that those in the higher tax brackets are getting a larger benefit from tax deductibility than those in the lower income tax brackets. The thought here is to even out the benefits by using tax credits rather than deductions. We will have to see how this pans out. Biden's plan as it pertains to corporations. Not much to mention here, but Biden would increase the corporate tax rate from 21% to 28%. If you recall, prior to 2018, the top corporate rate was 35%, which then was reduced for years after 2018 to the current 21% by the Tax Cuts and Jobs Act of 2017. Biden's plan would also try to capture some income on very large corporations with book profits over $100 million. This obviously has limited applicability for our audience here today, but the reason I mention this is because we all have seen headlines where large publicly traded companies are posting record profits for their financial statements while paying little or no income taxes. This provision seeks to address that issue. Biden would also increase taxes on certain international business operations. Stimulus update. I was really hoping that I would have something new to update as to the status of the various stimulus legislation negotiations, but as of today, November 24th, things seem to be at a stalemate. Prior to the election, the stimulus negotiations were primarily between House Speaker Nancy Pelosi and Treasury Secretary Mnuchin. However, since the election, Treasury Secretary has stepped out and the White House has left the negotiations to Senate Leader Mitch McConnell. It seems that Pelosi and Mnuchin were closer than Pelosi and McConnell. Economists have been calling for additional stimulus for the economy in light of the second wave of the COVID-19 pandemic. The fear of a double-dip recession exists and should be a leverage point in coming to a compromise. But again, it's Washington, D.C. We'll see what happens, but hopefully they do something soon. That said, some of Biden's stated priorities for any stimulus would include enhanced unemployment benefits. Many benefits are starting to run out. They would also look at additional small business help, perhaps, as we discussed earlier, PPP 2.0, maybe more targeted. He was also in favor of additional round of direct stimulus checks, the $1,200 checks that were sent out in the spring, another round of those. He's also looking at expanding emergency paid sick leave. And one thing that was interesting, and again, details are sketchy, he's also looking at providing student loan forgiveness for up to $10,000. Again, we don't know income limits, who's eligible. And Biden would also prefer to increase Social Security checks by $200 a month for the duration of the pandemic. So those are just a few of the things that Biden would be interested in being part of any stimulus legislation. We know that any pending stimulus legislation is very important to our clients. We will continue to keep everyone up to date as the tax landscape continues to develop as we enter this final month of this crazy year. That will conclude this section of today's presentation. Thank you very much for your attention and your attendance.